Okay, hi everyone. This is going to be the first lecture for chapter 21. We're talking about in this chapter dispositions of partnership interests and partnership distribution. So, like with all businesses we've talked about, right, there's kind of the formation, there's the operation, and then there's like the dissolution of the business or when you sell your partnership interests. So we're looking kind of at the back end of partnerships with regard to owners and selling their partnership interests, and then we'll also look at distributions to partners, whether that's an operating distribution in the normal course of business, or it's a liquidating distribution where the partnership has kind of come to an end. So when we're talking about basically the sale of a partnership interest, right, that's going to trigger the amount realized minus adjusted basis formula. And all along we've been saying we care about outside basis because that's going to be that number right there. So you have to know what your initial basis is and then modify it in light of your percentage of income or loss, any additional contributions or distributions you've made, any more debt that's been attributable to you, so on and so forth. So that was kind of a last chapter thing. And when we're talking about selling partnership interests, right, one of the first things here in that formula, amount realized minus adjusted basis, we have to be aware that by virtue of selling our partnership interests, if we receive debt relief, that's going to increase the amount realized. In other words, like you owed money, now you don't. That's like something you got in the deal. You got rid of this liability you owe. It's kind of like cancellation of debt income, right? You didn't technically get money, but you got rid of something, so we're going to treat it as if you did get something, which you did. So if we look here at 21.1, right, we have a partner who sold 30% of its interest for 100 grand. Their share of liabilities on the date of sale was 24 grand, and they had an outside basis of 105. What gain or loss here is the partner going to recognize? So basically the first thing we know, we're doing amount realized minus adjusted basis, where the adjusted basis is going to be our outside basis. When we're calculating the amount realized, clearly it's going to be the 100 grand we received, but we also have to include here our debt relief, right? We're off the hook now for 24 grand of a liability, so that is something we received. So what are the two things we received? Money, and we got debt relief. So that's going to make our amount realized 124. Back out our adjusted basis of 105. We're going to have a $19,000 gain. So the idea here is generally when we have that gain, it's going to be considered a capital gain. Partnership interest is like a capital asset, right? It's a non-business use asset. And the idea with it, you can be like a passive partner, a more active partner, but overall, it's just like selling a stock or a bond. It's an interest, it's an ownership interest in a business. So generally, therefore, it's going to be capital gain. However, what the IRS doesn't want you to do is, so if you think about this high level here, your ownership interest is kind of reflective of all the different assets that are within the partnership, right? So maybe you're a 1/3 owner of the assets, a 1/3 owner of the liabilities, a 1/3 owner of this. If the partnership was to sell or dispose of certain assets, that would trigger ordinary gain or loss, right? So for example, inventory. What they don't want you to do is basically take your sale of your partnership interest, treat it as a capital gain when kind of substance over form, your partnership interest, like really some of that represents, for example, a portion of the inventory. So had the partnership sold it, they would have recognized ordinary income, right? So the overall idea here is generally your sale of your partnership interests are going to be capital gain. However, to the extent there are items in the partnership that if sold would have treated ordinary income, you have to recharacterize some of your gain from capital to ordinary to reflect this. And really, the main items are unrealized receivables, inventory, and then potentially depreciation recapture, which we'll look at. So when we're talking about unrealized receivables, first thing you got to keep in mind is partnerships can have either be a cash basis or an accrual basis taxpayer. Cash basis is basically revenue when cash in, expense when cash out. Accrual basis would be revenue when earned, expense when incurred. So if you have an account receivable, first off, we know just from GAAP, general accrual principles, what you would do is debit account receivable, $100, credit revenue, $100, right? So that's like the overall idea with it. And you can see there, right, at that point in time, even though you haven't received the cash yet, you do recognize the income. However, with regard to cash basis taxpayers, they only include the income when it's a cash inflow. So if they make a sale on account, right, they're not going to have any income there until they actually collect the account receivable, because that's when there's like the cash inflow. Why we care about this then is if we have unrealized account receivable, basically just an account receivable we haven't collected the cash on yet, we're basically sitting on revenue that's going to come in if we were a cash basis taxpayer. Once we collect that receivable, we have revenue in, and that revenue would generate ordinary income. So accordingly, right, when we're looking at this overall framework of selling your partnership interest, some of it, the gain is generally going to be capital. Some of it is going to be ordinary if it's attributable to hot assets, namely items within the business that would produce ordinary income. Well, then a partner in a partnership that's a cash basis taxpayer that had an unrealized receivable, we would have to include that amount when we were recharacterizing the gain for the sale of the partnership interest. It's just, think about the idea of, part of your ownership interest is what's in the business. That's what it's kind of representing. The thing that's in the business, if we sold it, would generate ordinary income, or if we collected on it. So we have to recharacterize part of our gain to ordinary income. Accrual basis taxpayers, we don't have to worry about this as much, accounts receivable, because we've already recognized the revenue, right? We have the revenue and the ordinary income right here at the time of sale. Inventory, obviously, right, that's going to be something that if we sold in the partnership would generate ordinary income. So when we sell our partnership interest, we have to kind of look at our attributable share of that ordinary income when we're recharacterizing the gain. So let's look at 21.2 and 21.3 here. So this question just says, here's a balance sheet, right, of a partnership. They want to know which of the assets are considered hot assets. Well, in this case, it's going to be the account receivable. It's going to be the inventory. And in this case, it will also be the equipment. The reason being is if we were to sell this equipment, we would have depreciation recapture based on that difference there that would generate ordinary income. So we're basically just looking at things on the balance sheet that would generate ordinary income. 21.3 here shows us a similar balance sheet, and they say, can you please tell me what amount of the hot assets are there at the end of the year? So in this case, it's basically going to be the inventory for 200 grand. It's going to be the unrealized receivables, which are basically, in this case, the 50 grand depreciation recapture between these two. And then the 40 grand on the account receivable right there. So we kind of talked about the overall idea of it. the sale of a partnership interest, we said some of the gain we have to recharacterize as ordinary to the extent it's attributable to a hot asset. How do we kind of mechanically do this? So you're going to just figure out your normal gain first through your amount realized minus adjusted basis formula. You're going to then determine your share or gain or loss from the hot assets as if the partnership were to sell them. And then you're going to compare and net your gain against the ordinary income from the sale of it. And basically, whatever's left over, you're going to have as your capital gain or loss. So let's look here at 21.4 and 21.5. Okay, so we have here, it looks like we had a partner who sold their share of interest in a partnership, and it looks like when we did the calculation of amount realized minus adjusted basis, there was a $19,000 gain. Then what we do is we look and we say, okay, what were the hot assets that were in play here? So we would have the $13,000 of accounts receivable and the $6,000 of equipment, right? We're just drawing this from the previous, looks like, the $13,000 here and the $6,000 there, the difference. And then we say, okay, those are the hot assets. That's their kind of gross fair market value. We own 30% of them. So that basically means 39 and 1,800. We're going to have $5,700 of ordinary income attributed to us. So in short here, right, you sold it, you had a $19,000 gain, but of that amount, we're going to characterize $5,700 as ordinary income because it's from representing your share of hot assets, and the remainder is going to be a capital gain. Over here, this is just showing, the same thing, except it's saying, hey, you had an $1,800 gain, and you had $5,700 of your share of the ordinary income. The result there would put you at a capital loss on the sale of your partnership interest. Continuing here, I have a buyer of a partnership interest, so you have that external party. They want to know how much they should pay for the interest. However, they also are going to want to know what's their outside basis and their share of the inside basis of the partnership's assets. So, as a general rule, right, an outside basis, if you buy a partnership interest, your outside basis is going to be what you paid for it, plus any share of the liabilities you're going to be assuming. So if we look here at 21.6, right, it looks like we have a partner who sells their 30% interest to an outside partner. Then they say, what's the outside partner's basis? Well, they paid $100,000, and it also looks like they're on the hook. Their share of liabilities here is going to be $24,000. 30% of the liabilities, $80,000. Their outside basis is going to be $124,000. So what they paid plus their share of liabilities. I think we looked at this last chapter. So from a partnership perspective, right, the partnership itself is going to experience very few tax consequences if there's a sale of a partnership interest. Basically, the buyer, the person, the new guy who's coming in, they're going to step into the shoes of the seller partner to determine their share of the partnership's inside basis of the partnership's assets. So basically, the idea here is, remember we said there's outside basis and inside basis. Outside basis is what your basis in the partnership as a partner is. Inside basis is what the partnership as an entity has as a basis in the assets. Now, the general rule is going to be when we're allocating and we're saying, what is your share of the inside basis of the partnership's assets when you enter the partnership as a new partner, when you buy your interest, it's just going to be a carryover basis. Whatever the guy before you had, that's what you have. Also, you're going to take a kind of carryover basis in the capital account. Remember we said capital accounts are kind of equity accounts of the person you bought it from. So let's look here at 21.7. So they give us some facts here, and they're just saying, hey, can you please tell us what is the share of the partnership's inside basis? And in this case, right, it's going to basically just have an $81,000 tax capital account. And then they're going to be 24,000 share of liabilities. You're just stepping into the shoes of the person you bought it from. So the idea here is the inside basis for that amount, the share of it's going to be 105. The next thing here is the varying interest rule. So one of the things here is we said as an overview, right, if a partner's interest in a partnership increases, right, they contribute more capital, or it decreases from a distribution during the year, then income or loss during the year has to be allocated to reflect this varying interest. So basically, how do you deal with, we've just dealt with like stagnant ownership. You own 1/3, the partnership made $100. You do profit sharing ratios based on ownership interests. You have 1/3 profit associated to you. That's like a very simple thing, right? How does it work when your ownership interest during the year changes, right? That can make it a little bit more complicated. How do we proceed in allocation of profit or loss in this case? Well, basically, the IRS gives you two things you can do. You can prorate it based off your ownership interest, or alternatively, you can do this thing called an interim closing of the books. So let's look here at 21.8 and 21.9. Okay, so the idea here is we're going to say your ownership interest changed during the year because you sold your interest halfway through the year, right, to another person. So let's just say there's partner one, and then there's new guy partner. Partner one at halfway through the year sells their interest to new guy partner. How do we proceed here, given that during the year we overall had a $60,000 loss? How do we kind of allocate this, given those facts? So what we're going to do in this case is we're just going to say, okay, there was a $60,000 loss. Me as partner one, I had a 30% share of that attributable to me. But I only owned my interest for half of the year, right? So I'm going to have half of what's attributable to me from the loss actually be allocated to me. Now, in distinction here, under this interim closing of the books, what we do in this case is, let's just say, this is the selling partner and this is the buying partner. We still have an overall $60,000 loss during the year. But what we look at and what we do is we say, at the time of sale, in this case, right, it was like 6/30, how much of the loss, the $60,000 loss, did we have at that point in time? So it was 20,000, which means in the back half of the year, there was 40,000. So what we do is we just, instead of saying you owned it for 6 months, you get half of your share of the loss attributable to you. We instead are going to take more of a chronological approach. And we just say, we treat when you sold your share, your interest, as if we just closed the books at that point in time. So at that point in time, we had a $20,000 loss, 30% is attributable to you. And then for the new partner, for the last half of the year, it's like we imaginarily reopen them. And for the last 6 months, $40,000 of the loss happened then. They get their 30% attributed to them. So as I have here, right, tax treatment of a distribution depends on the type of distribution made to the partnership in light of outside basis. First thing we have to distinguish here are operating distributions versus liquidating distributions. An operating distribution is basically just one that's made in the normal course of business. Hey, here's some money pushed out to you as a partner in the partnership. And generally, right, we're going to just reduce our outside basis when we receive those. In distinction, and what we'll talk about like in the next lecture or two, would be a liquidating distribution. So this is basically where the partnership pushes something out to you. They give you A, B, and C, and this is basically for your partnership interests. We're at the end of the road. Here you go. This is what we're giving you for your partnership interest. It's a liquidating distribution. So with regard to operating distributions, right, this is basically a current distribution during the normal operating course of business. It's not going to terminate the partner's interests. And usually what we do these for, we're just distributing the profits of the partnership. It helps people who are partners in the partnership pay their estimated taxes from the partnership, right? And what they can be is basically money or property. Hey, here's some cash. Hey, here's some property from the business. And as a general rule, when the partner receives these operating distributions, they're basically just going to reduce their outside basis. And it's going to be, the idea here is you're going to reduce it by the cash and then by the inside basis of the property. So let's look at 2110 here. So it looks like we have a distribution of 250 grand cash to partner 1, 333 to partner 2, and 250 to partner 3. When we're looking at partner 2, can you please tell us what are the tax consequences of this? Well, basically, if you receive a distribution of cash, you just reduce your outside basis. You're not going to have any gain or loss, right? Getting cash is not a taxable event in and of itself. It could be if the distribution is greater than your basis. But basically, this just shows here the general rule of if you receive a distribution of money or property, you reduce your outside basis by that. In this case, your outside basis, wasn't fully eaten up. You still have 86 grand left over. The exception is going to be here whenever what is pushed out to you is in excess of your basis. Then you're going to have a capital gain in this case. So let's look here at 2111. Okay, so the idea with this is there's a distribution of 250, right? It looks like our outside basis is 205. What's our gain or loss? Well, in this case, you reduce your outside basis first, right? That's fully eaten up. Anything that's left over, the remaining 45, that's going to be a capital gain. However, remember, your outside basis can never fall below 0. So, after this distribution, you would say to me, okay, that's great. I have a $45,000 capital gain, but my outside basis is 0. What it's not is my outside basis is negative 45,000. Your outside basis can never fall below 0. Some of this can get a little bit more tricky. So I have here, if you have cash and property, then the gain is calculated before the receipt of the property. In other words, just look to the cash in the basis for gain. The other property cannot cause the gain. We'll look at some kind of examples with similar situations later on in liquidating distributions. But for right now, let's just get the general principles down. So I have here, if a partnership makes a distribution of property other than money, the partners are going to face the problem of how to reduce the outside basis for the receipt of distributed property. Generally, what's going to happen here is the partner is going to take a basis in the receipt of the distributed property equal to the partnership's inside basis in the property. So generally, if you receive property from a partnership in a distribution, your basis then in that property after the fact is going to be a carryover basis. Whatever the partnership basis in it was is now your basis. However, there's some specific ordering rules here when we're eating away at basis in the calculation. So basically, if you were to receive money in property as a distribution, and you're starting to reduce your outside basis for receipt of this, you have to first reduce your outside basis for the money. And then afterwards, you're going to reduce your outside basis for the property using the carryover basis. Whatever's left over will be your outside basis. So let's look at 2112 here. Okay, so we have a distribution here of 133 of cash, and it looks like there was an investment with an inside basis of 115, right? So we have a 420 outside basis. The first thing, because we have money and property, we said when we reduce this, we first reduce it by the money, the 133, then we reduce it by the property, in this case the investments, using the carryover basis, the 115. That's going to get us to 171. No gain or loss here, just reducing our outside basis. And, continuing here, right, when there's an operating distribution that exceeds the outside basis, again, there's special ordering rules. Basically, in applying these, you're going to reduce the outside basis to 0 and take an adjusted basis property received to the extent your basis was capped at 0. So in other words, things can get modified when there's a distribution of property and it takes you down below 0 with the gain or loss. So let's look here at 2113. Basically, the idea here is you're going to allocate your basis to money, to hot assets, then to property. And once it takes you to 0, that will basically help determine what your outside or what your basis in the property is. So if we look here, 2113, we have a 205 outside basis, and it looks like what we were given here was 150 of cash and then investments with an adjusted basis of 90, right? So in this case, we can see, right, what we've received is going to be greater than our outside basis. So we're going to be going into kind of an operating distribution that exceeds an outside basis. Whereas in distinction right here, we had an operating distribution that did not exceed our outside basis. So the first thing we do here is we reduce our basis by cash, right? Right there, money we got. Then we have our remaining basis. In this case, we then do hot assets, which in this case, and we have our other property here as well. But here's the deal, right? Our basis goes down to 0, right? It's fully eaten up by this $90,000. And then after the fact, our basis in these investments is going to be 55,000. Basically what took us down to 0. And then there's going to be no gain or loss in that case because the property took us there. So that's just showing us this guy right here, the special operating rules. 2114, you can look at yourself. I'm not as concerned with as depth treatment as that for the exam. So this is about a third of the way through the chapter. So let's pause here for the end of chapter 1.